Hey everyone, welcome to another Credit Shifu investment video. Today we are looking at the buy and hold strategy. Now this is a strategy I would recommend for most part-time investors, people who are saving for their retirement or to have passive income in the future, and they're doing it part-time so they don't have time to really pay attention and keep watching their stocks and everything like that. So first of all, what's the definition of buy and hold? Well, buy and hold is just when you buy stocks or ETF funds. I don't advise mutual funds, okay? This is just about stocks and ETFs. So you buy stocks or index funds, ETFs, and you hold them for a very, very long time. We're talking years, decades, or you perhaps never sell them. So why does it work? Well, most people recommend buy low, sell high, right? But if you are waiting to buy low, you may have to wait several years to even get into the market if you're thinking about buying during a recession, etc. And as for sell high, well, you know, if you've invested in stocks over a long period of time, great many years, and you own a great number of shares in that stock, if it pays a dividend, you're getting income from it annually or monthly or quarterly or whatever, and it's a good income, why sell? Even if the market's at record highs, there may be no point in selling because you're getting 2, 3, 4, even 5% dividend a year. Now, statistics over the last 100 years show that in the US and many other Western countries, actually, the stock market always rises over a period of time, no matter what, over the long term. Even though you may have massive dips like the recession of 2008, the Great Recession back in the 20s, I'm guessing it was, 20s or 30s? Anyway, I wasn't alive then, a bit before my time. But on average, you know, over a 10-year period or a century, the market always rises and rises quite a lot. So if you buy solid, what we call blue chip companies, which are sort of like often the market leaders or companies that you're pretty sure are not going to go bust. We're talking like Apple, Johnson & Johnson, Coca-Cola. You're pretty much guaranteed growth in the long term. And in addition to that, they often pay a dividend as well. Now I have several examples. So if you purchase Coca-Cola stock in January 1990, you would pay $4.60 for one share. If you sold it in January 2015, you get about $43 for it. That's an increase of tenfold, 10 times the price almost. Now you have to adjust for inflation, so $1 in 1990 had about the same buying power as $1.83 in 2015. So the value of the US dollar has roughly halved, okay? I'm not going to go super accurate with this, but so that still gives you an inflation adjusted increase of fivefold in value. So if you spend $100 on 21 shares of Coca-Cola in 1990, let's think of that as $200 because that would be the buying power in 1990 compared to 2015 dollars. You'd get $903 back in 2015, and all the time Coca-Cola would have been paying out a dividend which you could have taken as income or reinvested and used cash as well to buy even more stocks during the years when the price was down. You've made even more money. Now there's a story from Tony Robbins' book Unshakable about a UPS worker who never earned more than $14,000 a year. Now this is a little bit misleading because Tony doesn't adjust for inflation. So this guy retired in 1952. His final salary in 52 was $14,000. $1952, $14,000 in today's money would be worth $128,000. So his salary in his last year of retirement was $128,000. You know, that sounds a lot, perhaps if you're a young person just graduated, but do remember he had a career of several decades at UPS, and his final year's salary, once he'd worked his way up and was in quite a reasonably high up management position, was $128,000. I'm sure he struggled a lot and started on way less than that during the beginning of his career. Anyway, so he saved 20% of everything he earned throughout his entire career and just invested that in UPS stock. Okay, his company had an option where he could invest part of his salary in the stock of the company. By the time he was 90 years old in the year 1991, he had amassed a fortune of $70 million because his wealth, even after he'd retired in 52, his wealth continued to grow and he ended up with 70 million. And that's when he started giving his money away to charity and etc. And there was an article about him in the New York Times and all that. Now that's a really inspiring story about buy and hold investment. But because it was such a long time ago, it might be a bit hard for people to relate to. And also because he only invested in one company, there was a bit of luck involved. You know, could have gone either way. There was less. He didn't have diversification, which is what you really need for stability. So actually in Tony Robbins' book, there is another example which is kind of probably easier to relate to. And it's more of a hypothetical story. It's not actually about any one person, but he just did the calculations. So he calculates that one guy saves $300 a month every month from age 19 until 27. Right? So it's like 8 years of investing that he saves for, $300 per month. He does nothing after he's 27. He just leaves it in an ETF or index fund, tracking the S&P 500, reinvesting all his dividends. Now, Robbins uses a growth rate of 10% for this example, which, I'm not sure how he worked that out, but he says the long-term growth rate of the US stock market over, decades is around 10%. I'm assuming he's incorporating reinvesting dividends, typical, dividend into that. So by the time this guy retires, he has $1.8 million, and he didn't invest anything after he was 27. He then compares that with the example of another guy who starts investing at 27, again, $300 a month, every month, 38 years of investing, okay? He keeps doing it until he retires at 65, and he actually has $200,000 less, so like 1.6 million, $200,000 less than the first guy, who just started early, didn't invest anything after he was 27, and his investment just compounded. The compound interest did its magic. So with this kind of strategy, the longer you leave it, the faster it grows. And you can see that also in this graph from Business Insider. The way compound interest works is you get this big exponential growth towards the end. So the longer you leave it, the faster it grows. So you're at a real disadvantage if you start late with this kind of strategy. Now, in addition, buy and hold also has a tax advantage. So if you hold a stock or a fund for longer than 12 months and then sell it, the capital gains tax on the profit you made will be taxed at the long-term rate of capital gains. So if your regular income puts you in the 15% tax bracket, you'll pay 0% in capital gains. If you're in a higher tax bracket, you'll pay 15% capital gains tax on those profits. And naturally, if you earn over $400,000 a year, it's 20%, but that's not the case for most people. Most people would be in the 15% bracket. Whereas if you bought a stock and sold it within 12 months, any profit you made on that stock, the capital gains tax would be charged at your regular rate of income tax. And if you're in a high tax bracket, that could be as high as 39%. So this is another way in which a buy and hold strategy can actually make more money in the long term than short-term traders who get hit with these higher tax fees, etc. So let's recap. With buy and hold, you hold stocks or funds for a very long period of time, generally reinvesting your dividends to buy more shares and benefiting from compound interest at the same time as getting general upward growth in the market. You also get lower rates of capital gains tax if you hold the stocks for longer than 12 months, and if you never sell them, you'll pay no capital gains tax at all. Compared to short-term trading or even day trading, buy and hold reduces the stress because you're not constantly watching your stocks and the minute price fluctuations and asking the questions, should I sell now, should I buy now, which can really bring a lot of stress and strain on your health and your well-being. Now, these examples are for the US market. Obviously, there are regulatory differences in different countries, so for the capital gains tax thing, you'd have to check the regulations in your own country. I think the UK has a rate of 10 and 20% of capital gains tax, certainly much lower than the UK tax rates on income, which are as high as 45%. Socialists. Anyway, also with the market in general, there's obviously different market growth rates in different countries, depending how well the economy is doing in that. The only disadvantage I can really see is you need quite a lot of patience at the beginning because growth is slow at the beginning before you start to get that really steep exponential curve in the later years as your investments mature. For me, about 80% of my portfolio is in buy and hold strategy, so buying stocks and funds that I'm in for the long term with general growth, and I always make sure they have dividends so that I can reinvest those dividends and benefit from compound interest. And then about 20% of my portfolio is in, I use it to sort of day trade or buy and sell for riskier things, benefiting off of volatility, which is definitely riskier, and I sometimes will lose money on it. In total, I generally do make money, but you have to be ready to lose that money. So it's a little bit risky, and I'm not advising people to do that. So guys, what do you think about all this, the buy and hold strategy? Please leave your comments below. Give this video a like, subscribe if you're new, and we'll see you next time. Bye.